So when we're talking about income in the context of the share market, we're talking about dividends. Dividends are corporate profits that are paid out by a company, usually on a semi-annual or even on an annual basis. And it's not as important for all investors, but for a lot of investors, income is very important because it's providing them with a steady stream of cash flow. And additionally, a lot of companies also offer dividend reinvestment processes where they will issue shares in lieu of those dividends. So you're saving money on the brokerage that you would otherwise have to pay. A really important part of that focus on income here in Australia are franking credits. So these are designed to prevent the double taxation of those corporate profits. So it is a very important part because when a company is paying a dividend, it can be grossed up if it's fully franked by a 42% to account for that 30% tax rate. So it really increases the overall level of that distribution. And that's important, particularly if you're in a low tax paying vehicle like a self-managed super fund and you have a lower tax rate at 15%, you're actually capturing the difference between those two tax rates. So it's a net benefit to you. But one important consideration is as well that franking credits can only be used to offset other tax liabilities, other income tax liabilities. So if you have net zero tax that year, you're not actually receiving a refund. So that's a really important consideration for investors, and they need to really balance what they're trying to look for. Additionally, when you're looking for income, you should also consider whether that company does pay franked, either fully or partially franked. When we're looking at large cap blue chip stocks like CBAs and Rios and BHPs, they're often fully franked. Other companies might be partially franked, but if you're looking at more capital growth stocks, then they're unlikely to really have franking credits attached to them.